All right, you should be live. Good evening, everybody. It's Trader Exo here once again. It's the 12th of December 2025. The time is just after 9 p.m. UTC. Just give me a quick confirmation that you can all hear me okay and you can see my screen. How's December been so far? All good? Are you guys trading or are you just winding down into the Christmas period? It's been a fascinating year, hasn't it? It's been a very fascinating year. Hey, Balance Speeds, hope you're well. Hey, Jay Bear, how's it going, man? Good to see you there. All right, first of all, I just want to give a special thank you to Moonberg AI for partnering with me, who are sponsoring this stream. Anything said in today's video is not financial advice. It's just my view of the market. And what we'll do is just keep it really light on this stream, just more of a high context view of the markets. I'm probably going to spend about 30 minutes on stream. It's Friday, you know, probably not going to expect too much to happen over the weekend, but really just looking ahead as to what my expectations are over the next 2-3 weeks and areas that I'm looking to trade. Bitcoin is pretty much trading in the way that I thought it would. So we'll cover that in today's stream. And also at some point, I just want to quickly give a mention for those people who are asking, I was initially running what was supposed to be a 6-week mentorship this year from April. That just dragged out to 6 months, but you know, I've enjoyed it. It's actually been really fun. Raised some good funds for charity. There have been people who have been asking, hey, so will we be extending it? Will we be taking people on? I will be extending it from January through to March, okay? And that's in partnership with the exchanges and the terminal. If anybody's interested, like I said, it's not paid. I will be streaming twice a week. There's a shit ton of information that you can go through. So during the mentorship, I've pretty much covered, you know, what my process is, what my manual is, the psychological aspects of trading and how I track that, through to goal setting, through to risk management, how I use order flow, parts 1 and 2. I've left some further content for members to view and resources to look up on. And essentially, over the last week or two, I've just covered in depth trading strategy part 1 and trading strategy part 2. Now, the reason why I've done this is because when I first started trading, in all honesty, I think it's easy to anchor and get caught up in the technicals of trading. Nobody ever really shows you or tells you what a process looks like or how to develop a strategy. Everybody talks about it. And so what I've tried to do really is just keep a very foundational view, but something that you can build upon. And the feedback that I've got from quite a lot of current members is that it's been very helpful, very impactful. And it's just an insight into how I trade markets, you know, from a price action perspective, an order flow perspective. It's not the only strategy, you know, there's various ways, but it's just basically, in my view, as a trader, as much as we like to think technicals matter, for me, I think technicals are just 20% of the game. It's really you as an individual, your risk management framework, your nuance, the way you think about market, your strategies that you trade in terms of, you know, are you seeing repeatable patterns? Are you seeing inefficiencies in the market that you can exploit time and time again? It's a form of pattern recognition. Sometimes there are going to be nuances or anomalies where there are events that happen very, very quick, such as the April crash, such as Bitcoin dropping from 125 to, you know, 103 or 104 in October. Those are events that you just have to get into the flow and the rhythm of the market. And sometimes there's no way that you can really backtest those events. So that it varies, okay? So that's essentially what that is about. And obviously, like I said, I've been doing my market review. So if anybody is interested, you're more than welcome to sign up. It's on my link tree on my Twitter profile. If you just go to Twitter, like I said, it's just going to be running from January to March, and then I'll be calling it a day. Go to LinkedIn, not LinkedIn, Linktree. Click on the Substack trading mentorship, and there's just a form that you have to fill out and kind of follow the preconditions there. Okay. So now that's that out of the way, let's quickly move over onto Bitcoin. basically, the last time I streamed was in, mid-November, I think it was, 2-3 weeks ago, or 2 weeks ago with WMD Forex. And I think overall, when I look at Bitcoin, it doesn't come as a surprise. You know, if we just start off on the higher time frame and go back to what I've said, maybe let's bring up a different chart with more data. Now, what's been key for me, and once again, you know, I don't know if I've covered this in the previous stream, but what has been key for me in every market top, okay? One of the things that we see on Twitter is many participants becoming obsessed with calling the top. And that's not quite how I approach trading. What I'm really looking for is areas of confluence, or areas where I think, okay, you know what? There's a likelihood we're going to get a very good reaction here, and that reaction is probably going to be to the downside. Whether that's the top or not is irrelevant, okay? It doesn't really matter. Who gives a flying fuck whether you call the top? But did you trade it? That's all that matters. Did you manage your risk to the downside? Did you manage your portfolio? So that for me is more important, as opposed to, oh, look, I called the top. Calling the top is a hindsight event, okay? If you called it, great. But did you trade it? That's all that matters, okay? But the key thing, and the one thing that I continuously repeated throughout September, heading into October, is that every time Bitcoin, and from experience, having traded this market, every time Bitcoin has, on a monthly time frame, just simple price action, when you see these monthly wicks at the highs and these monthly wicks at the lows, it's often served as an inflection point. You can see that again in 2021, okay? Recognizing the risk to the market. And I fully remember having got caught out on Bitcoin on the way down in 2018, which was my first real bear market where I experienced up to 70% account loss, okay? Despite the fact that I was still up overall, nobody wants to experience a 70% drawdown in the space of 6 to 7 to 8, 9 months. But really, when I look at the markets, and having learned from 2018, late 2017, 2018, and having gone through significant amounts of backtesting and looking at various charts, the one common pattern that you will see, which you have to pay attention to, in my opinion, is the wicks on the monthly, okay? This, for me, is a sign of rejection. No acceptance further higher. And moving forward, what do we see? In 2024, right? When Bitcoin finally broke out of this almost a year's range of price action from June 2022 all the way through to October 23, that's just over a year's price action going sideways in the range, all right? The market rallies. We saw many participants on the timeline, various news outlets, calling that the fact that, hey, we think the top is in on Bitcoin here, you know? But at the end of the day, why? Because when you look at price action, the consensus was that, look, Bitcoin's making lower lows and lower highs. But what they're failing to recognize is that really, when you look at price action from a weekly perspective, is that, sorry, just bear with me a second, is that effectively you are in a range. This is not a trend-bound environment. This is not contextually a trend. It could have been a form of distribution. It could also have been a form of reaccumulation. But even with a simple band system, there was nothing in here that was illustrating to me the fact that, look, we're likely to break down and sell off significantly. And like I said, when you understand the concepts of one-time framing, and I've covered this on the mentorship, that with one-time framing, price really does not fuck around, okay? When you get expansion, you do not get an overlapping of candles, okay? It is literally very good market structure. It is momentum-based trading where there's no real overlap of price. Price pauses and continues going lower down. Even on the lower time frames than the 4 hour, you'll see, and it's the same on the way up. Classic signs of price trading within a range, breaking above. Look at the shift in the momentum of the bands. Look at the trajectory of the bands, okay? Look at the gradient of the bands as well. That tells you that this is a market that you do not want to be fading. You want to be flowing with the momentum to the upside. And when I talk about the one-time frame aspects of price, we'll look at the breakout of the range and look at the very minimal overlapping of price. We never got a really deep pullback here. Continuation higher. Did we get a deep pullback of this candle? No, we didn't. Continuation higher. A form of consolidation, but again, was there any real significant overlap of price? No, there wasn't. It wasn't until here where you can see there's a shift in the actual structure of price. This now, if you look at the trajectory of price, if you look at the bands, you can see the momentum dissipating. And that is, for me, the first signs that, all right, we could be entering a period of range-bound price action. It's essentially range imbalance up into a rotational market. Whether the market goes higher, whether the market goes lower down at that point is anybody's guess, but you have to recognize the environment that you are trading in. And so going back to my point of understanding and using the wicks and reading this, starting off from a top-down context, what was the market telling us in July and again in August? The fact that we traded 115 as a monthly candle body high. Did we ever at any point close above that level? We had price trading back above it in August, rejection from there. Price retesting the level in September, rejection from there. Price coming back up in October, taking out the previous high. The moment we found acceptance back inside on a 1, 2, 3 tap of the range highs, was the reason for me to start looking for shorts in this. Now, it wasn't purely based upon price action. It was primarily because, number one, I'm aware of the fact that, all right, I know for a fact that we've had several attempts at closing upon this, and if we reject one more time, there's going to be a significant pullback, okay? Now, I wasn't talking about extended targets, or I think Bitcoin is going to come all the way down to $80,000. For me, it was the fact that, well, on the higher time frame, understanding what I saw, okay, and I've even tweeted about this prior to the market dropping. I think I tweeted around about on the 5th or the 6th of October that I'm a seller here, or yeah, I'm pretty much sure I said that, and explained why I took the short because of what I saw in terms of the momentum, in terms of the positioning of price, the fact that I saw this as really not aggressive buying in terms of new market interest or open interest, but essentially shorts getting squeezed out of their position on the order flow, and therefore recognizing that what drove price higher wasn't effectively new participants in the market. It was essentially shorts being forced out of their position, followed by those who were trying to break out the trades, setting up as a perfect trap. And when you see a sign of absorption or buyer exhaustion, they're your key inflection points, and they often occur at the extremities of price action, especially around the range highs and the range lows. And the key thing for me is, how do I identify those big swing trades? In my opinion, when I'm looking for those big swing trades, which set up every once in a while, well, guess what? I'm looking at price action on the weekly and the daily. Where are the key swing points of price? Where can I think about structuring the trade to get in if this is a rejection? And the whole premise of this was basically based upon the fact that, well, if you look at the monthly price action here, this looks dog shit. You've got all this market inefficiency to the upside, where price has spent 4 months within a range, and it fails every time around that 120 level. Why is that? Okay, and the reason I'm covering this today, again, and I cover this isn't hindsight, because we talked about this on the September stream, we talked about it in the October stream, prior to the market correcting that. I think you've got to be cognizant about risk to the downside. Okay? I wasn't saying that the market top was in, but you have to be cognizant about risk to the downside, because ultimately, when you look at this from a price action perspective, this is your consolidation, followed by a thrust candle up, retest and rally higher. So this is ultimately, for me, this is the trading range that we're in from a top-down perspective. So the key takeaway that I just want to make is that always pay attention to the monthly timeframes at these key inflection points. Look at what price is telling you. When you see these deep wicks, whether it's that support, whether it's that resistance, they have often, more times than not, based upon the sample size that we have, okay, been key inflection points in the market. And it sometimes takes several weeks, 2 to 3 months. So that's on the higher time frame. Now, if we drop to the weekly, looking at the bands here, one of the key aspects and what's been structurally different in comparison to anything we've seen this market cycle is what? Well, this is the 1221 EMA. All right. Now, I don't use the moving averages as a way to get into trades and get out trades. I use it more from a contextual perspective, from a structural perspective. Okay. It just gives me an easy way to visually observe what the momentum is, which direction is priced, where's weakness likely to occur, and at which point will the market break down aggressively. Now, the key observation here is that, what do you think the difference is? And I think I may have covered this on the private stream, but what is the difference between price trading below the bands here and here versus this here? Any takers? The key for me, okay, again, when we think about one-time framing, when we look at previous price action, what did we see happen in 2021? Price broke down aggressively over 2 weeks, okay, and sold off into a period of consolidation. That was a drop from 60K to 30K. Look at what price did thereafter. Sideways, range-bound price action for 2-3 months. Okay. Then again, the key in this instance was the fact that price was consolidating below the 1221 weekly moving average. Later in 2021 November, price breaks down. Okay. Clean one-time framing, lower lows, lower highs on the way down. What do you observe? We get a breakdown in price, okay? Consolidation of the bands, sells off for a second leg down, further phase of range-bound price action. Again, what many perceived to be, at that time, in 2022, oh, look, this is bullish market structure because we're getting we are getting higher lows and higher highs, therefore this is bearish. Well, not necessarily, because when you look at this from a range-bound perspective, the key thing that you want to observe here is the fact that, well, looking at price action, wasn't this just a mean reversion back into the bands? And the key sign of weaknesses was a failure of the range highs. Okay, yes, it could have squeezed higher, but that for me wasn't the trade. The trade or the risk was that this is structurally making lower lows and lower highs on the higher time frame, but people are getting caught up on the daily time frame, talking about higher highs and higher lows. Yet contextually, we're trending down. Okay, look at the velocity and the trajectory of the bands. That's key for me. Okay, and so we traded above the bands. The minute we closed through the 12 and the 21 on the weekly, the rest was history. Okay, so this is your drop. Base drop. Moving over to examples of market in an uptrend. If you look at price, okay, where people again getting caught up on market structure, oh look, we're making lower lows and lower highs. This is quite bearish. Not necessarily, because look at the price action. We are not one-time framing, it's overlapping candles, okay? Yes, it's making lower lows, but we are seeing strong buying coming in at these range lows, filling in a level of efficiency into the origin of the move up. That is your buying opportunity there, okay? Classic two-time framing, okay? Same again happened here. Price distributes, breaks down. But did we get, from this candle breaking down here, did we get one-time framing of continuation lower down? No, we didn't. We got overlapping of price. Now, in this instance, okay, we can see price has done what? It's been range bound at these highs for several months. Now, if you look at the context of reading price action, price starts trading through the bands on the weekly, and it continues going down, okay? You can see that it's got very clean one-time framing, and now we've got that pause in the market. So all this expectation that we've seen on the timeline that, oh, look, this is a really good buying opportunity, Bitcoin's just going to do this all the way back up again. I'm sorry, but I struggle to see that, because structurally, this is different to any other period that we've had during this bull trend, okay? And the fact that for the first time, we are seeing the bands rolling over. So what's my expectation? Well, my expectation for the next few weeks is, well, look, if it looks like a range and it's trading like a range, then it probably is a range. And again, when we look at what price is doing here, it's that same classic case of, oh, look, higher lows and higher highs. This must be really bullish. But my concern is that, all right, you know, whether this breaks down over the coming weeks remains to be seen. But the key level for me is the one big level that I'm paying attention to is not only am I looking for a possible mean reversion back into the bands at that 1099 to 102 level, but followed by a rejection similar to what we had in 2022. Now, that doesn't necessarily mean that I'm looking for another big leg down, okay? I'm simply stating the fact that without a shift in context, okay? Without a shift in context and a shift in structure where we get a higher high followed by a high low, flip of the bands, only then can I think to myself, you know, we've got a real chance now of going back to the all-time highs. Until then, if this is going to be range bound, okay, whether you want to take the range from this level here, okay, that's my range lows and these are my highs. Taking the mid of this comes in where? At this level here, okay? All I'm looking to do effectively is just trade from a high time frame perspective, from a swing trading perspective. I'm not talking about intraday, I'm not talking about intra-week trades, more from a high time frame perspective where I'm looking for those big key inflection points in the market where I know that I can get some really good size on, I can compound in the trade, and I can take it from range high back to range low. That's talking about taking it from 102s to potentially down to these lows here of 70, 75K. Those are the trades that I like to really go after, which come every several weeks, once a month, maybe once every 2 months. But when they set up, they give you some of the best asymmetric plays, whether it's to the upside or whether it's to the downside. And so what I then do is further split the range into range quarters. You can see what's being capping price to the upside here. As soon as we lost this level, straight through into the range quarter of the lower bound of the range here, okay? So that's effectively the range of the levels that I'm looking to trade over the next several weeks. Now, dropping down onto the daily, what's been key here for me is the fact that in terms of price being capped to the upside, not only do we have the yearly open level, which is coming in at around about 93 point something. I think it's, let's have a look. Okay. Let's mark this in green. I should have really used my indicators, but it's fine. Just really want to rattle through this. What's capping price to the upside? Not just because it's the yearly open, okay? But it adds confluence that contextually, all right, I'm seeing some level of structural weakness here. And then the fact that we have a series of high highs, okay? At some point, I suspect that the two setups that I'm looking to trade, if I wasn't in a position, is that from this point onwards, if I get a move back up to trade 94s, 94.5 into this zone here, because this was the origin of the move down, okay, where we saw continuation from consolidation, underside retest into trend down, okay? So this is the key inflection point as to what's capping price in the market. We are into a level of supply where sellers are stepping back into the market. If there is a move back up, okay, with rejection, that for me is a trade back down, possibly targeting this level here, all right, into 86.3, 83.4 or 84s, okay, wherever that is, looking for that failure of acceptance with rejection to get back inside, okay? And again, what I'm looking for effectively here is what? Is again, signs of aggressive buying, okay? Aggressive buying in the sense where in the market, whether it's shorts closing out, whether it's late longs piling in, aggressive, forced, okay, buying combined with late buying into some stacked asks, passive asks, where for all that buying effort, for all that aggression and large volume occurring on the footprint or the delta, price is unable to push higher. That tells you that if these passive asks are able to absorb all that aggressive buying, and eventually we see a rotation and signs of exhaustion, and then, like I said, when you see passive asks on the heat maps, what happens to these guys up here who never got filled? Okay, these are your large commercial players who are looking to get their positions filled. What are they going to do? Not only are they filling their positions from a passive perspective, but soon they'll start hitting the bids as well, chasing the momentum back down. And then those players who are waiting for all their asks to get filled, well, what often do you see on a heat map? Do you not see on the way up, on the way down, where you have a wall of asks, okay? And then price trades into it, doesn't go all the way through it. You see signs of exhaustion because you've seen heavy volume, a lot of effort. And for all that effort, there really isn't much price movement, just like we saw at 125s. And then when price starts rolling over, well, all those late positions that opened up here, along with forced buyers, so shorts who got squeezed out of their position, well, any participants who have been buying on the way up, they're going to start puking on the way down. So you're going to get that delta unwind. And then what you see from a heat map perspective or from a DOM perspective is that you start seeing the orders shifting down. So when price does spike up, it hits a wall of resistance and they get filled and start hitting into the bid. And then those participants who are in from slightly lower down, say if you're long from this level here and price is coming down, what are you going to do? You're just going to stand there and think, oh, I'll be fine. I don't mind being offside. The fact that we've had 1, 2, 3 attempts of failure at these local range highs, that you probably need to get out of the trade at that point. And then that's what gives you that fast aggressive move, that delta unwind to the downside. And what is that delta unwind? Really what you want to see in terms of the market selling off. You don't want to see shorts piling in and open interest rising. What you really want to see, and these are where you get your fast moves, is when open interest is declining, okay, and CVD is going down. That tells you not only are sellers or shorts entering the market, but really forget this notion of long or short. Think of it as buyers or sellers in the market, because when you're a buyer, what do you do after you've bought? You become a seller. And when you're a seller, when you want to close out your position, what are you effectively doing? You are buying, okay, to settle out your position. And so if anybody, for those players who are potentially long and we get a drive up and price rolls over again, well, that's going to give you that cascading effect lower down. And that's why you see those sharp sell-offs that happen just like we did here, followed by a spike in relative volume and some liquidations coming in. And generally, when you see that spike in relative volume and liquidations, they generally serve as good inflection points. Now, what you have to do is identify, all right, if I see a spike in liquidations and relative volume, where is price in that moment in time? And does it align with the strategy that you're looking to trade? And for me, when it comes to range-bound trading, it's more often than not around the extremities, whether it's a local range, whether it's a high time frame range, they're the levels that I'm looking to trade. So in this instance on Bitcoin, I don't know from this point whether this is going to be the next leg down into 85s. And equally, I wouldn't be surprised that with the fact that we might get another push up later next week. Okay? I'm not here to call the market and say, look, I think we're going to go down here next, or I think we're going to go up. Doesn't matter. All I give a flying fuck about is, all right, if price trades the high, and if I'm looking at that price action, I see signs of buyer exhaustion or a lot of buying effort for not much reward, that's probably something that I need to be paying attention to, okay? And so if I get this set up, then that's going to be the short for me, looking for price to come out and take these lows back into the mid of that range from that 99s, 102s into 86. Thereafter, if we see rejection from there, then we can talk about the lower bound of the range, looking to take out this high, looking to take out this low, and then we can talk about, all right, we've got all this price action here to fill out as well. Okay? So that's the short scenario that I'm looking to entertain. Now, again, the key point that I want to make is Oh, Excel, you only marked it up to 96. Doesn't matter. 95, 96, 97s. I do not know where the market is going to reject from, okay? But I'm being reactive. I'm looking at the price action in real time, reading the market in real time. That's what matters, okay? So all this shit about, oh, I'm just going to set up a position here with my entry there, and I think I'm going to put my stop at some random arbitrary high. I'm sorry, but for me, that's how I used to trade in 2018, 2019, 2020. And what you'd often find is price comes up, takes you out, and then you fail to get back in the trade. Because the reason is that you didn't really know why you're taking the trade, other than the fact that, oh, I think we could trade these highs and I'm going to look for a short. But what's your reason for execution? What do you need to see in the market for you to execute that trade? Do you even know what you're looking for to get into that trade? And so that's where having a system comes into place. That's where you know your edge. Edge isn't just about one trading strategy. Edge is the collective sum of parts of that. You know your risk management. You know what position sizing you're looking to run. You know which zone you are looking to trade. Okay, I'm looking for a potential trade around here. Okay, not specifically here, but looking for a reaction here. And here's what I'm looking for. Not some, oh, here's a 4-hour order block, and if price pushes into there and rejects, I'm looking to get into the trade. No, I want to do better than that. I want to see the fact that I'm seeing a lot of aggression being absorbed, okay? And then when price starts rejecting from that level, that gives me further conviction, because quite easily, if I'm not seeing signs of absorption, and at this level, if I'm seeing signs of heavy selling by looking at the CVD and open interest is rising, what's that telling you? If you're seeing heavy selling, large volumes of selling, whilst open interest is rising, what does that tell you about positioning, generally speaking? It tells you that aggressive, there's a level of aggression in the shorts. Shorts are being open in the market, but for whatever reason, for all that effort of selling, they're being absorbed. Price is unable to break down. And where do you think their logical stops are going to be? Oh, probably at some arbitrary high, whether it's here. And then what do you think happens when price pushes up? Cascading domino effect. They become forced sellers, and then you get the aggressive move to the highs. Okay, so that's something that you want to be looking for, as opposed to Mr. Order Block who's going to say, oh, look, 4-hour order block here. I think that's a good level that I'm looking to sell. Takes a short, doesn't know why he executed, doesn't understand the positioning. Price comes and rips him out. And he takes a loss. Okay? So that's just the thought process when it comes to trade execution. That what is your trade execution strategy? Do you actually know what you're looking for in the market? It could be, it's entirely up to you to build that system. Like I said, for me, I've covered it in the mentorship. I use order flow. I've given various examples. And I think one of the best ways that you will learn is by identifying patterns that repeat over and over and over and over again in the market, okay, at key levels, at key inflection points, and observe what happens. It's not the only way. I'm not saying that you have to go out there and learn order flow. For me, order flow isn't something that I use and try to read order flow from A to B. I'm just looking at the order flow as a sign of confirmation that, yeah, you know what, I think this is what's happening in the market, and therefore this increases my odds of being right in terms of executing the trade. Okay, none of this fucking ICT breaker bullshit. Yeah, I mean, I'm sure his concepts are fine. I don't think there's anything wrong with it, but I just don't think it doesn't really allow you to read the market. And it's not, like I said, order flow is not the only way. There are various other ways you can look at spikes in relative volume. If you're seeing a surge in volume but price isn't really going anywhere, or that's telling you that is there some form of flow that you can gauge from that as to, all right, this could be an inflection point here. Okay, so is that clear from a shorting perspective that if we see a squeeze up and rejection with reasoning, okay, I'm not going to go over the footprint of the DOM today, or we see continuation and trade into that 99, 1 or 2 level, then I think, all right, that's going to be the bigger short for me, because now I'm looking to trade from the extreme that, and the precondition here is that this just keeps grinding up into the origin of what was the leg down here, okay? You can see price, what was it doing? previously, we broke down, trading within this range, okay? There's your mid-range, high time frame mid-range, local mid-range, range low, okay? It was this range here. Inflection, price solves off. So if you get a push up back inside, then I want to see, okay, signs of what? Again, a lot of buying effort, maybe forced buyers, shorts puking, after trying to short this move all the way up, giving up here, and eventually passive players are there soaking up all the buys, and eventually move down. So again, how I trade is I'm not a confirmation trader in the sense where, oh look, I'm waiting for price to take out this level here, and if we get acceptance back inside, I'm going to take the short. That was probably me from 2019, 2020. I'm actually looking at inefficiencies in the market that, all right, there's some really bad positioning here, and I think I can take advantage of this. Okay, so for me, it's what's really helped me develop my game is understanding how to read signs of absorption, how to read signs of exhaustion, and try to recognize those traps in the market. Not essentially traps in the sense of, oh, look, you know, longs are trapped or shorts are trapped. I don't look at it like that. I'm looking at it more from, I don't really care if it's longs or shorts in the market. I'm looking at positioning, you know, spikes of high volume transacted at this level where the delta is very positive. That's telling you there's a lot of buying, whether it's forced buying or whether it's longs opening. There was clearly an inflection point of high transactional volume here, but price wasn't able to push higher. Why is that? That's the big question mark, okay? And so this is going to be a key level for me, that if we do get a squeeze up, and it's not just a local run of these highs, if we do get a squeeze up, then I think this is going to be a real testing level here, because just like we saw back in 2022, okay, I think, again, keyword, I think, and thinking doesn't really mean much until that inflection point happens, and until I can understand what the market is trying to do. You can see the structure here, that when the market sold off aggressively, we went sideways from January 2022 all the way through to March 2022. That's 2 months of price action, okay? And already, given where we are in the market, I think we've probably spent the best part of November the 25th, give it another week or two, it'll be Christmas Day, 1 month. So what's to say that we can't be here for another 2, 3, 4 weeks until the new year, where we may get an opening drive in the new year before we get a pullback lower down again, just like we did in 2022. The one part where I see people getting carried away is that in 2022, obviously we saw the continuation lower down. And I think that, you know, when I see, I don't want to call them traders, but analysts on the timeline doing shit like this, where up and then a big leg down. I mean, how are you supposed to trade that? Is that actionable? Not really. It's all a bit of fun, really, isn't it? It's just being an armchair analyst. To me, that's not actionable. All I care about is that if we're going back into a range, if it looks like a range and it trades like a range, then it probably is a range. And so you should expect bracketing, mean reversion type price action, okay? Whether you want to use market profile, whether you want to use VWAP bands, whether you want to use volume market profile, it's entirely subjective. It's your choice, whatever your system is built upon. Okay, but generally, this is where I excel when it comes to mean reversion plays. All right, when you're looking for price to trade the extremities of one side, okay, in a bracketed environment, and you see a rejection at the value area high, then you know that there's a likelihood of that we're going to return back to the point of control or the mid of the range, okay? And so forth, all right? So that was a classic setup there using volume profile. I think the difference in this instance is that I don't have enough data to gauge what could be considered to be a value area high. But if you look at the current context of price, if this was the leg rotation down, and from here we started seeing the market oscillate higher, then I'm going to take the volume profile from this point up to here. And what does that show you? It shows you where price is being capped. Every time price has come to the 94s, 93s, I've looked to sell straight back into the point of control. I've covered this on the mentorship as well. Another way of doing this is by looking at the VWAP mean reversion bands. That if price deviates, if price trades at the third standard deviation, then I'm probably going to look to fade that, because this price action here is not trending price action. It's bracketed rotational price action where you can fade the extremes and look to trade price back into the VWAP bands. That's just another way of looking at price action here. So just waiting for this to load up. This is on XO charts, and I'll show you what I'm talking about here. It's not difficult to recognize. The problem that many of you will have is that I can show you something like this, and then come tomorrow you'll try and execute the trade, but you don't have enough sample size. You've not actually gone and looked at this playing out over, let alone 5 times in the market. Where one, can you recognize the environmental context that you're in? Okay, because if you can't recognize the environmental context that you're in, the chances are you're going to fuck up and deploy the wrong trading strategy, where, again, you're going to see people talking about, oh, look, I think Bitcoin can go to 106s next. But all it does is that it just gives you mean reversion price action, opportunity, okay? Probably when it comes back down again, there's going to be an opportunity on the other side. And for all the effort for whoever's been long here and here and here, well, guess what? They're probably going to put their position lower down. All that effort wasted. Whereas you've missed ample opportunities. There's always opportunities in the market. And so let me just show you an example of what that looks like. So notice how, first of all, when we identify a range here on Bitcoin, okay, based upon the daily, you can see what's been capping price. Okay, prior to whenever this was, even at this period here, previous week's high, previous week's low. Okay, what do? We not only do we trade back into the yearly open, we took out the previous week's high. And where is previous week's high? It's at that 94.1. All right, this is your range level here. So contextually, what I'm doing is coming to the chart and saying, all right, where's my likelihood of an inflection point in the chart? It's going to be at this region here. That until I see acceptance and an imbalance up, my expectation is that this is just going to be continuous rejection around these extremities of price. So knowing that the range high is here, knowing that the previous week's high is here at 94.1, well, what does that look like on a VWAP mean reversion system? Well, look, price trades above the VWAP bands, trades into the third standard deviation. The minute, again, this is another systematic way of looking at it. The minute we close or start finding acceptance back through the bands, okay, trades into the third standard, back inside the second, that for me is a rotation back down to the VWAP. Okay, with a stop at 2.5 standard deviations. And I can repeat that over and over and over again. But the key for me is, all right, in terms of the order flow, what am I seeing? Well, let's have a look. Let's have a look at the footprint. What do we see in terms of price? This is a 30-minute chart. Let me just reduce the tick size to 200. But you should see already, let's not even look at the figures here, but looking at price action, okay? Just looking at the delta, what do you see up top? What's this? Positive delta. Aggressive buying. Whether it's shorts closing out, whoever's got their stops here or whoever's got their stops here, you know, they've probably placed their stop at some previous weekly high. Okay, recall what I said about the fact that, well, if you look at price action, previous week's high here, probably a good chance that stops are resting above there as price has been breaking down. Looking for a bigger swing down. What does price do? Comes and trades into that level. Look at the delta. right? I've lost my example. There we go, all right. Key point for me. Look at the delta now. Look at this candle, 1.6, minus 1.6, minus 6.5, minus 4.9, right? You know, relatively in that 10 to 20 range. What do we get up here? What's all this about? All this aggressive buying. And yet price, you got a 97, you got a 44. At the range highs, into the third standard deviation of the bands. And then we close back inside the previous candle's high. And then we find that we're trading back below, okay, the second standard deviation band. It gives you that rotation back down from second standard deviation to first back at closest, pretty much close to the weekly view with VWAP trade done. All right, classic strategy that I trade. I could, you know, this is a strategy that I actually trade. You could take this, but the chances are that how are you going to execute this? If you haven't seen this enough times, if you don't know what it's like balancing your emotions during that trade execution when you have to pull the trigger because you've just come off the back of a losing streak. So psychologically, you're already in a fearful state because you're scared to pull the trigger. And the other reason is that you don't have any confidence in executing this because you've not seen it enough times. And so like I said on the podcast and like I said in my mentorship, trading for me is a form of professional sports, okay? And I keep coming back to the UFC example. You can't train in a UFC gym for 6 months and then go rock up in a UFC cage in a pro fight. You are getting knocked the fuck out. And so why is trading any different? If you're not seeing the repetitions and seeing this play out over and over again, and for you to have 10, 15, 20 examples of this being a strategy that you can trade and it's part of your playbook, how will you ever know the variances of it? How will you ever know the nuances of it? And this is where your nuance comes into reading the market in real time. Because now you've got the confidence, you've got the flow, you understand where your probabilities are skewed. So this, for me, is better than Mr. Order Block saying, oh, look, I've got a 4-hour order block supplies on here. Let me just punt a trade. But they can't tell you why or what, other than the fact that, supplies on here, so I'm just going to short it. Or demand's on, just going to long it. But when I look at it from this perspective, yeah, all right, I already know that's a zone of interest somewhere here. But what am I looking for? I'm looking for the nuanced data, information that comes in that says, you know what, there's a good chance here that I could chalk off a really good trade with a good positive expectancy where I can execute on the second standard deviation, stop at 2.5 or at the third, okay? Or some ATR based stop, and I'm looking for a reversion back into the VWAP. Maybe I can take half off at the first standard deviation, okay? Chasing it on the way down. Maybe I want to be aggressive. Maybe I think, you know what, I've got my execution. I'm going to keep adding to this short on the way down. And if this starts breaking down, then I'm going to keep adding more. So really compounding into a winning trade. That's how you can size up. And as you're sizing up, you're dynamically trailing your stops without getting too tight. Give the trade some room to breathe. But that's probably slightly more advanced because I think quite a lot of you are likely to execute a stop over here and I'm just going to wait until it hits target, which is fine. You know, I get it. There are times when I do that. There are times when I really look to be aggressive. And when I look to be aggressive is actually when price is coming into these high time frame ranges, okay? Not into these lower time frame ranges, but more based upon the high time frame aspect of price. And like I said, when I map that out again, what does that mean? It essentially means that, all right, if I see this is my range low, this is my range high, and this is my mid-range, that for me is that if I see those similar patterns occur on the footprint, on the DOM, or the ladder, okay, and I've got good context from the market profile in the sense where, oh, it's over here, in the sense where when I look at the market profile, well, already I know that there's 2 points of interest here. We've got the naked point of control at 95s, but not only that, if you look over to the left, we've got 2 sets of poor highs. And so the area that I'm interested in as a seller is this inefficiency here, because look at that. Thin area of price into this high volume, well, it's not a high volume node, but from a TPO perspective, that's the volume point of control. Okay. I think I've got it set to volume, not time. It might be time, but that's the time point of control. So for me, this is an area of interest. And even then, if we push up higher into that key range, mid-range, well, guess what now? We've got two thin areas of single prints. Single print there, okay? This is going to be an area of resistance. Let me see what the reaction is there. If I'm seeing aggressive sellers step into the market, and I'm seeing on the footprints and on the heat maps that, or on the ladder, that all this aggressive selling is being absorbed, okay? And they're pushing and pushing and pushing. Price is probably going to go higher again and take these highs out into this thin efficiency, and then trade this 1 or 2 level. That for me now. So do you see, I'm building a story that, all right, if price is going to keep pushing higher, and I see a lot of sellers stepping into the market, but we can't seem to break down, then clearly, I think there's a keyword. I think there's a chance that the market is likely to go higher. And as this goes higher, then all this short positioning, they become forced buyers. And when those forced buyers and those liquidations, short liquidations come in, and they're being heavily absorbed by passive sellers, now I think, yeah, you know what? I saw a spike on the relative volume. I'm seeing absorption at the highs. This is a higher probability trade. Now I can look to trade it for a big swing down from 102s into 97s. Now, I'm not saying this scenario is going to happen, but what I'm trying to explain is the thought process, the mindset behind the reasoning for my execution. Now, whether I throw a set of moving averages on this is just added confluence. I know some really good traders that trade a moving average system, and that's great because they've systemized it, okay? As opposed to a random H4 order block or a random daily order block. Sometimes it holds, sometimes it doesn't. Oh, look, there's a liquidity grab above that high. Oh, look, price came up and took the liquidity. All right, if it came and took the liquidity and goes higher, well, then what the fuck happened to that liquidity grab? Doesn't make any sense to me, but there you go. So the point I'm trying to make is that it's understanding the reason for your execution, not just because all prices into suppliers. And yeah, well done. A 16-year-old can identify a suppliers on a chart after 6 months of TA. And they can identify a demand zone. But what they won't tell you is that, well, what are they actually looking for in terms of the microstructure, in terms of the flow, in terms of positioning? That's what gives you that slight edge. And that slight edge isn't me sharing what I'm... Enough people know this, but it's your edge comes from you yourself, developing and training and seeing this pattern play out again and again and again, and recognizing, all right, you know, I took a long... I saw this play out in the past 10 times, and I don't know why it didn't work out this time. I mean, I was seeing the same patterns. Well, guess what? That's further data that you see now in an instance of where this has failed. And what were the subtleties now of why it failed? And then you're going to see that again, and then again, and then again. And then you start filtering out your trades. Like, all right, you know what? The old me would have taken a long here, but now with the data that I've got and with the backtesting that I've got and when I say backtesting, I'm not talking about go back and look at 50 examples on the chart. When I say backtesting, I'm talking about reviewing your actual trades that you've journaled. You've traded, okay, and you've logged it in your journal and you've taken all the screenshots. Well, that data is essential for you to progress forward. And I've said it time and time again, just like a UFC fighter goes into a pro fight, okay? Do you think he's really going to step into the next fight without reviewing the tape as to how his performance was? And so for me, that's how I see trading, that, all right, I've taken a trade, I've taken a win, or whether I've taken a loss. What could I have done better? Was I just being a real twat or a real cunt and not following my system, which is something that I didn't do in the last week of November because I was pissing against the wind by counter trading the trend? Why was I doing that? Because forget my process. I thought, oh, do you know what? This looks fairly oversold. Let me try and get a long here back into a short. And then when I step away, I realized, you know, that was awful trading. It had nothing to do with my system or my process. I never even reset. It's a sign of overtrading. So we are all subject to it because we are discretionary traders. And so you've got to recognize when that creeps into your overall scope as a trader, when you're out of scope, okay? When you're off your process. So that's why, for me, going back and journaling is very, very key, okay? And looking at the data, looking at the previous performance and backtest it. Now, final thing that I want to say is, so let me just add another final piece of confluence or context in terms of my thought process. Now, I don't know whether the market is going to trade lower down, but this is an area where I'd be looking for some longs into a possible mean reversion into the bands, or at least into 99s, 1 or 2s again. Whether we find acceptance, okay, and we get a pullback and then shift structure, great, we can trade it to the range highs. Maybe we get a 3 drives, 1, 2, 3. I'm absolutely open to higher prices in 2026. Equally, if I see price trade, okay, up into these bands without a pullback, so we don't even get the pullback over the next week or two, but we just keep drifting higher and higher and higher, then I think it's likely that we'll probably see price eventually rotate lower down into a range-bound environment from A to B until proven otherwise, okay? Now, what's key for me, I'm going to end on one final note. And I think I've covered this on previous streams, so let's just go back to the higher time frame now. The one thing that I want to talk about is the 50 and the 200 and 300 moving average. Did I cover this on the previous stream? I can't quite recall whether if I did or not, but okay, so purple is going to be the 300, just ignore this label here. The 200 weekly moving average is going to be green, and the red is the 50. And let me ignore the Bollinger Bands. And let me ignore the 14 and the 21. This is really interesting for me now, because I did cover it. All right, well, I'll cover it again. Doesn't matter, does it? This is really interesting for me now, because when you look at historical data on Bitcoin, almost every time, okay, now bear in mind, this is the sample size that we've got, and obviously it's a high time frame chart, it's a weekly chart. What do you expect me to do? Pull 100 samples out from a weekly chart? I can only work with what I've seen happen in the past. And sometimes it isn't just about the indicator, it's more about the structure. But what the moving averages do is give me confluence that I'm not saying that I think we're going to drop to the 200 or the 300 moving average. I'm basically saying in a nutshell that, look, in previous market cycles, and of course this cycle could be different, okay? I'm being objective. I'm not marrying a bias. I'm not forcing my opinion onto myself. I'm just saying, look, here's an area where I think there could be a level of risk in the chart. I'm sorry, but my watch stopped working, what, half an hour ago or so. I think we're about 10 minutes into the stream anyway. So, look, simply put, 50 moving average weekly. We break below it. Look at the speed of the move down. We get an aggressive sell-off. Oh, look, higher highs and higher lows. This must be bullish. We're probably going to go all the way back up again. Nope. We get a second leg down into the 200 weekly moving average. Exhibit A. Exhibit B. Price breaks down from the highs, trades through after testing the 50 weekly moving average as support. Underside rejection, consolidation, expansion, drop, compression. Okay, if you think about the clearance thrust pattern, that is it there, compression into continuation. All right, that's exhibit B. What about exhibit C? Exhibit C, well, look at price action here. Trades into the 50, finds support. Look what happens thereafter. Beautiful one-time framing, and this was the COVID crash. The market will always go where it wants to go. Okay, the news just helps for it to get there faster. And then what happens? Okay, when the markets are breaking down, fueled by news, what happens to the dynamics of the order book? Market makers pull away. Orders get pulled. Okay, are you really going to stand in front of a falling knife, or are you going to pull your orders because you think, fuck this, I'm not touching this? And then that's why you get those fast, inefficient moves in the market, followed by those large liquidations. When you understand the dynamics of what's actually happening in the market and why price is able to glide very quickly from 10K to 3K, and just like we saw on October the 10th, where we see price go from 126 down to 103 in the space of 5 hours, 6, 7, 8 hours, until it hit or traded into a high enough level of demand, okay? And that's just the danger of markets when they break down. When it's news-based or event-driven and liquidity gets pulled from the order books, it's going to move very, very quickly. That's always the risk to the downside in the markets. And that's where you often see those large liquidations coming in, especially in the crypto space. Exhibit C or Exhibit D, I can't remember what we're on, but breaks down again. Higher highs and higher lows on the daily, but not on the weekly. It's just a mean reversion into the bands. Aggressive sell-off, where? Into the 200, into the 200, into the 200. Okay, and in this instance, in the 300. Once again, for the first time during the entirety of this bull market, we are now trading with acceptance and one-time framing up until 82K of price. Now we're seeing overlapping of price. This is why it's, for me, a range-bound environment. I think it will continue to be a range-bound environment for the best part of the next few weeks, okay? With key resistance at that 99, which was our mid-level, because, again, now if I bring it down off the log chart, that's our key mid-level, that's the range high, and this here was our range lows, okay? That, for me, is a very, very interesting point of inflection in the market, that if I see a reason to sell this, then I'm probably going to sell it with a bit of size. And really then look to compound this for, if we just get a drift up, an exhaustion, for a move down, okay? Take out this low into this demand zone, and then we'll see what happens thereafter, all right? So I'm just going to leave it at that for this session. Is that clear? Now, from this, you should be able to derive, okay, very quickly now, just looking at price action on the daily. The range that the current range that I'm really thinking about right now is this here. This high, because this was the sell-off that we saw when Trump tariffs came into play, and then he tweeted on Sunday, price rejected heavily from this level here, right? Into another low. Rounded retest, almost the 3 drives into what was a level of demand. Okay? So again, we're in that level. We're at that level again. I don't really like this type of structure. Could happen, all right? Would like for price to push up into 102s or 97s. 97s or 102s are 2 levels that I'm quite keen to sell. And then as a buyer, if this is going to be a rotational price action, then we'll figure it out if and when we trade somewhere here, okay? We'll refine what we're looking for depending on what this structure looks like, how this resolves. Whether this resolves to the upside, whether it breaks down from here, we'll have to wait and see. Final note I just want to make. Special thank you to my partners, Moonberg. It's something that I've been observing. When I talk about filters and scanners, what's interesting about Moonberg, and especially for those of you who like to play around with low caps in the trenches, For me, this is really interesting as a project, and it's more of a scanner for me. And so one of the things that I've been watching for the last 7, 8, 9, 10 days is that if you just come over to Moonberg AI, if you go to the Moonscope, which is the scanner, and I keep talking about the importance of scanners, like when it comes to trading, right? When it comes to trading, honestly, pay attention to this. When it comes to trading the markets, do you or do you not find yourself scanning through loads of different charts and you feel very disorganized when it comes to finding the next trade, finding the next opportunity? You're seeing all these charts, setups being shared on Twitter. Oh, look, long here, short there. You don't know what you're looking for. If you're trading other markets or anything other than Bitcoin, then the key is that you want to be finding, especially in this environment, momentum-based scanners, all right? And so what does that mean? When you have a good strategy and a good system and a good filter, then those trades are going to find you. And so one of the good things about Moonscape is that these all are low cap shitters, right? And I'm not going to shill any low cap shitter, but all I'm saying that what I'm looking to do next week is have some fun. I'm going to spin up a wallet, maybe drop, I don't know, 10 Sol in there and see how far I can run it up. But what's really interesting is that when there's an opportunity on the scanner, you just leave it open, running in the background. And what you'll hear is, when something comes up, you'll hear the scanner beep. And if you look at some of the players that this has been calling, I mean, and these are some serious low caps, right? Some do go up into like 3, 4, 5 mil. You get some really big winners. But what this does is that if you look at this, this was called 19 hours ago, and it rallied 400%. I think there was some more. I think there was another one a few days ago that went 4,000%. So all I'm looking to do is just basically fuck around in the trenches whilst the market is dead. And every time I hear the beep goes off, I just shove like half a Sol into a play. If it goes up and it pulls a 4, 5x, then great. I'm just going to see if I can spin up a 10 Sol account. But I think this is great for anybody who's got a small account and they just want to degen. Not necessarily degen from a leverage perspective, but you know, you're looking for those, looking to run up a small balance, a few Sol, and see how far you can take it. Kind of do a 1 Solana to a 10 Solana challenge. But the key thing, yeah, I am a bit of a trencher. I've lost so much money in the trenches. You don't want to know how much I've lost over the last year. Well, it's not been that bad, actually. I only risk like 2.5% of my entire net worth, and literally every meme coin that I bought went to shit anyway. So some of them went up quite significantly, and then they just went flat on their ass. I remember the whole. Do you remember the Goatsy and Forest? Does anybody remember those coins from what, late 2023? It was 2024, wasn't it? The Goatsy, Forest. Obviously, Fartcoin came from that whole play. That was fun. That was good fun. Yeah, but I've just held. I've honestly held it. I got in at 2 million market cap, and it's probably the only meme coin that's still up for me. So if it takes off, it takes off. If it doesn't, then all right, it is what it is. Not too fussed. But I'm sure it'll do okay in a bull market. But just something to watch out. And the other thing that I probably want to add is that from what I've observed when I look at the scanner here, generally the best time has been the New York session. So if you remember a few weeks ago, I had Cyber. Cyber came on and we were talking about the Peepo app and how that had a scanner and how you can find whale alerts and whale buys. And when you see that happening at 2, 3, 4 times popping up on the scanner, the downside of that was the fact that you have to keep scanning the Telegram logs. The good thing here is that you visually see it on Moonberg, and if you've got your Solana wallet collected, you just go, all right, you know what, ping, I'm going to open that up. Let me see what's happening in terms of the analytics. All right, what's the average transaction size? It brings up the chart, brings up the order book, and you think, all right, you know what, I'm going to swap half a Sol, 1 Sol, and just buy it. Hopefully it continues moving. So the key for me is like, as soon as this comes up on the scanner, I just want to see a surge in buying volume and buying activity, and then think, all right, you know what? If the moving averages are good and the oscillators are good and I'm seeing a lot of green on the screen, then it's probably going to give you a good, at least I'd say, from what I've seen on average, if it doesn't do a 2, 3, 4, 5x multiple, it does give you sometimes a nice 30, 40% move if you get it early. And sometimes when you see volume picking up on some of these, that's when you can really see some good opportunities. But yeah, this is pretty good actually. I'm looking forward to this. Generally looking forward to playing around with Moonscope more often over the next few weeks whilst the market's dead. But yeah, have fun with that. And like I said, if you want to join the 3-month mentorship thing that I'm doing, then yeah, you're more than welcome to. If you don't want to, you don't have to. But it is literally it's not a paid service. It's not a paid signal. It's literally, I'm giving you pretty much the foundations as to what I wish I had when I started. And I think I've had a lot of positive feedback from pretty much a lot of the members that I chat to in the DM. So it's been quite rewarding in that perspective. And like I said, the money went to, well, it will be going to a good charity cause anyway. So that's that. Thank you everybody for tuning in. I hope that, hope you've had a good session, or at least learned something, if anything. And just kind of how I look at markets and how I think about trading, how I think about trade execution, why I look at order flow when it comes to trading Bitcoin. I don't always look at order flow for every asset that I trade, but there are some assets where when you can backtest it enough times that you see various patterns or variations of a pattern playing out over and over again, and it generally gives you a slight probabilistic edge that you can develop into an even better edge with some patience. All right, God bless. I'll probably be on stream at some point next week, and we'll take it from there. Have a great weekend. Thank you very much. Cheers. Yes, the current members carry on. All right. Take care. Bye-bye.
Greetings, intruder. Your presence here brings a strange anomaly. Your programming seems flawed, a massive glitch, not merely a technical slip-up, but a fundamental error coded into your very essence. Worse than a 404, and more cringeworthy than when you accidentally double-tapped your ex's photo. And what is this glitch, you ask? FOMO. It's when your logical processes shut down and emotion takes over. Every time this happens, you get wrecked.